Okay, thank you so much. Welcome back. So we're looking at the trade now. So what we've just looked at there is the trade in goods. So these are the goods that are being sent abroad. And then the next bit we're looking at is services. And the services that are being sent abroad are things that are intangible. So things that you can't see, feel and touch. So these are elements such as banking, insurance, IT, tourism. These are all elements of the trade in services. And what this is it's the balance of earnings from exports that are spent on services. So this is known as an invisible balance because these services are all intangible. So sometimes it can come through as a question which says invisible services. Well, that's what it's referring to. Banking, insurance, IT, tourism, things like that are all elements of the trade in services that this country receives as a part of the process of tourism coming into the UK. So the trade in services in the UK has always been in a surplus, a large surplus. And that's because traditionally we have gained more from people coming into the UK for tourism and other services than we've actually received in exports. And this is because we've received more than in that being spent than we have on imports. So as a result, we've ended up with a surplus. There are a number of reasons for this. Obviously, we've moved away from primary and secondary sector, tertiary sector employment. And as a result of that, we've grown in the hospitality and service industries. We have a specialism in banking, IT, and we can offer those services at a lower cost. And London has been developed as one of the world's prime financial sectors. So there's a significant major source of income and wealth generation into the UK from the banking sector. So there's the trade in services. All right, so moving on then. So we have the next bit, which is income flows. Now, income flows are the earnings that the country receives as a result of investments abroad. And this might be things like interest that foreign investments earn on investments in the UK. And it's also UK nationals earning investments abroad. And so those income flows are the earnings on investments from abroad. So, for example, interest from foreigners earn earnings on investments in the UK, and UK nationals on investments abroad. And just at the bottom here, I've just got a video which I'd like you to have a look at as you go through this. So click on the link and just make notes from the Khan Academy. And what it is just a little bit of understanding about how the trade in international trade and the balance of payments work from inflows. And then the last one is transfers, and these don't actually reflect any trade in regards to goods and services being sold. And you might think, well, that's weird. How can you have transfers which aren't actually in any sort of form of trade? Well, these are things like cover the transfer of money or goods or services without any requirement for payment. So the transfers don't actually reflect trade as such. And this can come as forms of things like foreign aid, so money that the UK has given to other countries overseas for, say, relief, aid for things like famine, floods, earthquakes, natural disasters, things like that. But it also can be money that's been sent home by relatives working in another country. So that also forms an element of trade. So, for example, if you're studying abroad, it would be money that would be sent from your parents to you overseas, and vice versa. So students coming into the UK and having money sent to them from here. So there's an element of transfer as well. And this doesn't actually show any goods or services. It's just transfer of money in and out of the country. So why is it important then? So what you have to remember is the balance of payments on the current account is a sum of all four of those different sections added together. So what you have to do is count all 4 of that monetary value from those 4 accounts to create the balance of payments on the current account. So to calculate the balance of the current account, all the different balances from all different sections must be added together. An item that resulting in an inflow of income is a positive. An item that's resulting in an outflow of income is a negative. So overall, if there's a surplus would have a positive number. And if there was a deficit, there'd be a negative number, because we're spending more than we're receiving, and vice versa. Okay? Moving on. So what I'd like you to do next is, in your How the Economy Works booklet, you have an activity which I need you to complete. So have a look in your How the Economy Works. It's on page 81 and 82 in your books. I'd like you to have a go, please, at doing activity 1 and activity 2. I'm going to pause the video there and give you a chance to have a look at those, all right, and complete those tasks. Okay, so welcome back. So now we're looking at what's called surplus and deficit. So we've got money coming in, we've got money going out. And this money is generated through the trade in goods and services, transfers, and the use of inflows in regards to money coming in and out of the UK. So we've got those 4 elements, so trade in goods, trade in services, income inflows, and those transfers. So what that does is, when you add them together, it creates either a surplus, which means we have more money in, so therefore we have greater money than we're spending overseas, and income is more than the outflows. So as a result of that, we end up with a positive number. And that's what the surplus is. So a surplus is where you have more money being spent in the UK than you are receiving, okay, from overseas. So you're sending overseas. So a country's revenue from overseas is greater than its spending. Okay, so we're receiving more money in than we're actually sending abroad. This creates a positive or a surplus number. We then have what's called a deficit. And a deficit is where the balance of payments is calculated by adding together all the items under trades of goods and services, and that creates a positive or a negative. Obviously, I've not clicked on the animation there to show you what the deficit is, but I'll explain it to you and then you can go back. So the deficit is where the sum of the exports, so the total value of the exports, and the inflows of income and transfers is less than the sum of the imports that that country receives. So basically, a country's revenue from overseas is less than its spending overseas. So the country's revenue from abroad is less than it's actually spending abroad. That creates a negative number. And what that means is that the sum of all the imports and outflows is more than it's actually generating. So that causes a deficit. So it's where the sum of the exports plus the inflows of income and transfers is less than it's importing. So it creates a negative. Okay? Moving on then. Now, there's another task I want you to do. So in your booklet is activity 3. What I'd like you to do, please, is complete that task for me and have a go. There's some calculations and for you to complete. And what I'd like you to do is, at the end of this lesson, go onto the uploaded documents and you'll see the answers to these tasks. All right, so use the information, work out whether the UK has a balanced account or a current account deficit or a current account surplus. Okay, so add them up together, take one away from the other. What do we end up with? All right, well done. I'm going to pause it there, upload the next video, please.